Hi all. So today I will be discussing the capital asset pricing model, or the CAPM model. And to kick off with a short example, imagine you have $10,000 to invest that you want to place. And you can decide whether to put this in a government bond and earn a relatively stable, safe return, or you could decide to put it into a portfolio of stocks, like for example, Apple, Tesla, Nvidia, and earn a potentially much higher return, but also under a lot more uncertainty and volatility. So here's the question in this case. How much return should an investor, just like yourself, actually demand for taking on additional risk? And that is the question the CAPM model tries to answer. And by the end of this video, you'll understand the intuition behind the CAPM, what beta actually means, how to use the CAPM equation, and why this model is still used in finance despite being almost 60 years old. So let's start off with a simple idea. You have one stock A, with an expected return of 10%. And then you have stock B with an expected return of 7%. So if you look at this at first glance, stock A might seem a lot better. But what if in reality stock A is extremely risky while stock B is relatively stable? A rational investor shouldn't simply ask which stock has the highest return. They should also ask, am I being compensated adequately for the risk that I'm taking? And this is where CAPM comes in. The basic idea is remarkably simple. An investor should only be compensated for the risk that cannot be diversified away. And this distinction is fundamental in finance. Looking at systematic and unsystematic risks, these are the two main components giving rise to the CAPM model. So imagine you own shares in a single company, but then that company could have a terrible CEO. You could lose an important customer, or its factory could burn down. These are examples of company-specific or unsystematic risk. There's also another type of risk. For example, a recession could hit the entire economy, interest rates could rise, inflation could surge, or a global financial crisis could cause stock markets to fall. These events affect many companies simultaneously and constitute systematic risk. CAPM argues that investors should not receive additional expected return for taking on unsystematic risk. Why? Because of diversification. Diversification can eliminate very much of the systematic risk. Imagine if you own one stock, and then imagine owning 500 different stocks across dozens of industries and countries. One company going bankrupt isn't going to destroy your portfolio, but if the entire stock market falls 30%, diversification isn't going to completely save you. That market side risk is what CAPM focuses on. So how do we actually measure systematic risk? The CAPM uses a variable called beta for this purpose. Beta measures how sensitive an investment's returns are to movements in the overall market. A beta of 1 means the investment has roughly the same sensitivity to market movements as the market itself. A beta greater than 1 means that the investment tends to move more than the market, whereas a beta below 1 means that it tends to move less than the market. So for example, suppose a stock has a beta of 1.5. If the market rises by 10%, we might expect that the stock would rise by around 15%, all else considered equal. Similarly, if the market was to fall around 10%, we might expect the stock to fall around 15%. It's not a prediction, but it's simply an illustration of what the beta represents. So now consider a stock with a beta of 0.5 instead. In that case, if the market moves 10%, the stock might move approximately 5%, all else equal. And in this way, you can think of beta as a measure of an asset's exposure to market risk. This gives us everything we need to construct the CAPM equation. So the CAPM equation is expected return equals risk-free rate plus beta times the market risk premium. So in this mathematical form, it looks like this. If we break that down, we have RF, which is the risk-free rate, we have the expected return of the market, which is ERM, and then the market risk premium is the expected return of the market minus the risk-free rate. And lastly, we have the company beta. And so the market risk premium here in this case actually represents the additional return investors demand for investing in the market instead of a risk-free asset. Whereas the risk-free rate is the return an investor could theoretically earn without taking a meaningful risk. Finally, the beta tells us how exposed the particular investment is to that market risk. So in theory, what CAPM says is required return equals compensation for waiting plus compensation for taking systematic risk. So let's put some numbers into this equation and do a worked example. So suppose the risk-free rate is 4%, suppose the expected market return is 9%, and suppose our stock has a beta of 1.2. If we first calculate the market risk premium here, we would do 9% minus 4%, which is equal to 5%. We would then multiply this by the beta, so we had our beta was 1.2, then multiply that by 5% equals 6%. And finally, we add together the risk-free rate, and this gives us an expected return of 10%. We could also do a second example where, for example, let's say that here instead of 1.2, the beta was 0.6. Then using the same of the rest of the assumptions, we would actually end up with a total expected return of 7% instead. So the second stock would have a lower required return because it carries less systematic risk. And if we notice something important here is that the CAPM doesn't tell us that the first stock will actually return 10%. It tells us the return investors should require as compensation for the risk they're taking. That distinction is extremely important in practice. So we can finally also visualize the CAPM using something called the security market line, or the SML. If we plot the beta on the horizontal axis and we plot the expected or required return on the vertical axis, then the security market line would slope upwards according to the market risk premium. And a stock with a beta of 0 would theoretically have a required return equal to the risk-free rate. So the security market line starts at the risk-free rate. A stock with a beta of 1 would have the expected market return. And stocks with higher betas would have higher market returns, or higher required returns. The slope of this line here is the market risk premium. And this graph here gives us a very intuitive definition or interpretation of CAPM. It's that more systematic risk should require more expected return. So going to one of the final parts here is why or what are some expected or some potential problems with the CAPM model? Because the CAPM model is not perfect. The model primarily relies on a number of very strong assumptions. First of all, it assumes investors can diversify efficiently. It also assumes investors have homogeneous expectations about returns and risk. And it assumes markets function in a relatively frictionless way. Perhaps most importantly here is that the beta doesn't explain everything about expected returns. Empirical research has also identified many other factors that appear to matter, such as company size, value characteristics, momentum, profitability, and investment patterns. And this is one reason, for example, that models such as the Fama-French 3-factor or the 5-factor models were developed. So CAPM shouldn't be viewed as a perfect description of financial markets, but it's better understood as a foundational model that gives us a clean framework for thinking about risk and required return. So in conclusion, the CAPM tells us that an investment's required return depends on virtually 3 things. That is the risk-free rate, the investment's beta, and the market risk premium. The central insight here is that investors should only expect compensation for systematic risk. The risk cannot be diversified away. That gives us the famous equation of expected returns equals the risk-free rate plus the beta times the market risk premium. Thank you very much for watching this video.